All right, so welcome to method 4 of valuation, and this method is known as the price to book value method, or we use the price to book ratio to value the stock. So when do we use this? We use this when the company has no profits, when the company is making losses. Now, some of you may ask, why would I invest in a company if it's losing money? Yep, so ordinarily we only invest in companies where the sales and the profits and cash flow are growing consistently, right? Yeah, but there are times when we may want to invest in a company that's losing money because we think that it's losing money temporarily. For example, when the banks were losing money during the great financial crisis, it was a temporary situation. Or for example, when certain companies were losing money temporarily during the COVID-19 pandemic. And we know it's temporary, that it will recover eventually, right? So in the meantime, when it's losing money, but we think it's still a good company, those are situations when we may still want to invest. Or we find a company that's not making money, but it's deeply undervalued. So the share price is selling way below the liquidation value of the company. Liquidation value means if the business were to close down and sell everything and clear its debts, what's left for shareholders is called the liquidation value. Now, if we can buy at a price which is 50% below the liquidation value, that's a good deal, because even if the business closes down, we can still get more money than what we paid for it. So these are exceptional circumstances where we may want to buy a company that's losing money temporarily. Okay, so in those instances, how could you value the stock? We can't use PE ratio. We can't use price to earnings ratio because there's no earnings. We can't use discounted cash flow. We can't use discounted net income because they're all negative. So when it's negative, you can't use it. So the only thing you can compare the share price to is the book value of the shares. So what does book value mean? Let's go into that in a short while. But let's just understand again, when do we use when do we use the price to book ratio? So again, number one, we use it for companies that are losing money temporarily. Okay. Number two, we use it for banks. Now, banks are a very unique animal. For banks, we don't use discounted cash flow. We don't use discounted net income. We simply measure the price to book ratio of the bank and compare it to its historical average to see if it's over or undervalued. And again, I'll give you a lot of examples in a while. The third instance we can use it is when we are valuing property developers or REITs, real estate investment trusts. And when you buy a REIT, essentially you're buying a portfolio of properties. So is it expensive or cheap? Well, we have to find out what is the book value of the REIT. So in other words, if the REIT were to close down, sell all its properties and pay off the debt, what's left, right? So that's called the book value. All right, so let's go through this step by step. So we're going to be using this ratio known as the price to book ratio. This ratio compares the share price we are paying to the book value per share. So what does book value mean? Okay, now book value basically means the liquidation value of the company. Once again, what's liquidation value? It means if the company were to liquidate means close down. If the company closes down, what happens? It sells all its assets. It sells the property it owns, it sells the machinery, the equipment, correct? It collects the cash and pays off all its debts. Now what's left behind, it's known as the liquidation value, also known as book value. So how do we calculate the book value? We take the total assets of the company minus the intangible assets like goodwill and brand, because that disappears when the company closes down, and we deduct all the debt, all the total liabilities. So what we get left is the book value of the whole company. Now, when you take the book value of the whole company and divide it by the total number of shares, what happens? You get the book value per share. Okay, which means every share you own, what's left behind for a shareholder. That's what it means. So we want to compare the share price to the book value per share. So to do that, we use this formula, right? We take the share price divided by the book value per share. So for example, let's imagine there's a company, and if the company were to close down, sell everything, pay the debt, what's left is, say, $100 million. That's the liquidation value. If the company were to close down, what's left is 100 million. Okay, and let's imagine that there are 100 million shares outstanding. So you take the total book value divided by the number of shares. The book value per share would be $1. Right? So theoretically, if the company were to close down, you should get $1 back. That's what it means, right? Now, what if the share price is now selling at 50 cents? So what's the price to book ratio? You take 50 cents, which is the share price, divided by the book value per share, which is what, $1, you get 0.5. So is that a good deal? That's a pretty good deal, because it means that I'm paying 50 cents to the dollar. For every 50 cents I pay to buy the shares, I'm getting $1 worth of the share, even at liquidation. Does it make sense? Right? So when you invest in a company that's losing money, there is a risk that it could close down, that it could go bankrupt, right? So you want to make sure that even if it goes bust and it sells everything, what you get is $1, and you want to pay less than $1, so you will get back more than what you paid for. So when we use the price to book ratio to value a loss-making company, ideally we want the price to book ratio to be 0.5 or less. See the logic? All right, so that's the first reason why we may use the price to book ratio method. Okay. The second time we use it is when we are valuing banks. So we want to find out the price to book ratio for the bank, and to find out if it's expensive or cheap by comparing it to the historical price to book ratio. Now, in general, the fair value for a bank share is a price to book ratio of between 1 to 1.2 in general, all right? So let me show you some real examples right now. So over here, I've got one of the biggest bank in Singapore, which is known as a DBS. It's a Singapore bank. And you can see this chart showing you the price to book ratio for the last 10 years. And as you can see, it fluctuates, right? So you can see the price to book ratio went as low as 0.6 during the financial crisis. It went as high as 1.55 in 2018. Right, so it goes up and down. So over the last 10 years, what has been the average price to book ratio for DBS Bank? Well, it's been 1.11. There you go. So it's as simple as that. So it tells you that 1.11 is the fair price of the bank, right? So anything above that is expensive. Anything below that is cheap, okay? And you can see it gets expensive to cheap, and so on and so forth. So about 2 months ago, during the COVID-19 crash, what happened, right? The price of DBS Bank dropped, and the price to book ratio went down to about 0.96. What do you think I did? I started buying like crazy because it was a great deal. So anytime the price to book ratio goes below 1.11, is below the historical average, that's when I start buying aggressively. Now again, you never know how low it's going to go, right? Now, after I bought at 0.96, it started bouncing back up already. Okay, But if I bought at 0.96 and it went down even lower to 0.8, what would I have done? I would have bought even more. That's right, it's an even better deal. So this is cheap, this is dirt cheap, because you know if you buy a good bank at the low of the price to book ratio, eventually when it goes back, you're going to make a lot of money. You're going to double your money easily, right? Now at the same time, when do I not want to buy DBS Bank? Now, obviously, if the price to book ratio gets above 1.27, I'm not buying anymore. It's too expensive, right? If it goes to 1.4, are you nuts? It's at the top, it's probably going to come back down again. So what's the current price to book ratio of DBS Bank? Well, really simple. Just go to Yahoo and you can get your answer. All right, so I'm at Yahoo. I'm going to type in, or go to my browser, type Yahoo DBS Bank. All right, so the current share price is $23. You know, I bought it at $17 about 2 months ago during the crash. So sitting on some pretty good profits. I was at 23. Do I want to buy more? Well, let's look at the price to book ratio. Let's look under statistics. Let's see if it's under statistics. Yep, it's here. Okay, there we go. So the price to book ratio for the most recent quarter is 1.15. So 1.15, is it still cheap? Let's go back to our chart. Okay, so at 1.15, it's somewhere here. That's right. So you can see that it's still reasonable. All right, like I said, if it's above 1.27, it's too expensive. But 1.15, it's still reasonable to buy. But like I said, you know, I bought it at 0.96 right here. That was a great deal. You know, now it's okay. I don't mind buying, but you know, I'm hoping it's going to go back down again so I can buy even more shares. All right, so that's DBS Bank. Now, let's look at the US bank. This Bank of America. And you can see that for Bank of America, this is the last 5 years. And this is the price to book ratio. You can see it went as high as 1.3, as low as 0.5. Okay, now the average for the last 5 years for Bank of America is a price to book ratio of 1, roughly about 1 times. There we go. So for Bank of America, what it's saying is that above 1 is expensive, below 1 is cheap. And when it gets above 1.2, it's getting too expensive. If it gets below 0.8, it's dirt cheap. Now you can see again, about 2 months ago during the COVID-19 crash, right, Bank of America, the share price dropped all the way to 0.8 price to book. Guess what I was doing? I was buying like crazy because it's a steal, right? So now I've bought it, it's now coming back up, and currently the price to book ratio is about 0. I think it's reached about 1 if I'm not wrong. So right now it's at fair value. It's okay to buy now, but like I said, I bought it at 0.8. So you always want to wait for these crashes to really buy a lot. You get it really cheap, so that once it goes back to 1.2, making a lot of money, right? You can start selling, take some profit. Let's take a look at what's the price to book ratio of Bank of America right now. Now again, we can use Yahoo, or for US stocks, you can use Finviz. Right, let's use Finviz. Excuse me, Bank of America, and the price to book ratio is now 1.03. There we go. Right, so it's right now at the fair value. Not expensive, not cheap. It's okay. You can buy it right now. All right. So in general, you can see that for banks, the fair price is about 1 to about 1.2. That's a fair price. Okay. Now there are exceptions to this rule. With everything, there are exceptions. So one exception would be JP Morgan, which is the largest bank in America, and because its growth, it's still really high growth bank, people are willing to pay a premium for the price to book ratio. So you can see that for JP Morgan, in the last 5 years, the average price to book ratio was 1.4. and 1.6 is becoming a bit expensive, 1.2 becoming cheap. All right, so for JPM, it's a bit different. The moment it's below 1.4, I start to accumulate shares. And again, during the COVID crash, it went down to below 1.2. It was good enough reason for me to accumulate a lot of shares of JP Morgan. All right, so that's how you value banks by. All right, so the third thing we can use this for is when we value property developers and when we invest in REITs. Now, many of you know that I invest heavily in REITs, real estate investment trusts, because I believe that in any portfolio, you need to always have a good allocation towards real estate. So for me, I tend to buy real estate from all around the world. I buy the best prime properties in the US, in UK, in Singapore, in China, through REITs. And with REITs, I own real estate, industrial real estate, residential real estate, and it provides me with a steady stream of passive income every quarter, right? So when I invest in REITs, how do I know if it's expensive or cheap? Again, I use the price to book ratio. So what is an ideal price to book ratio? What's expensive, what's cheap? It depends on the market. So let's take a quick look. Now, you can see that for Singapore listed REITs listed in Singapore for the last 16 years, you can see the average price to book ratio is 1.1. All right, so that's a good general average, which means that above 1.1, expensive, below 1.1, cheap. Okay, so in general, when I invest in Singapore REITs, ideally, I want to invest when the price to book ratio ideally is 1.1 or lower. Now, if it goes to 1.2, it's still okay, right? So yeah, maybe 1.2 or lower, that's fine. But if it goes up to 1.4, 1.6, then that's crazy. It's too expensive. All right. So ideally 1.1 or less. The most I will go is 1.2. But at the same time, when I invest in REITs, I also look at the dividend yield, also known as the distribution yield. And the yield that I demand when I buy REITs is at least 5% per year. Okay, so when the share price goes up too high, the yield tends to fall below 5%. So again, when the yield is 5% or higher, and when the price to book ratio is below 1.2, it tells me that the REIT is reasonable to buy. So let me give you a few examples right now. All right, so over here, I've got a list of some of the high quality REITs that are listed in Singapore. And by the way, Singapore is one of the best markets to invest in REITs because some of the best REITs are listed in Singapore. So over here, you can see the list of REITs. And again, what am I looking for? Two things to know if it's expensive or cheap. First thing is the dividend yield and the price to book ratio, also known as the price to NAV ratio in the Singapore context. All right. So I'm looking for yield more than 5%, right? More than 5%, and a price to book or price to NAV of 1.1 ideally or less. So which are the ones that are still reasonably priced? We have got this one, Capital Mall Trust, that's still reasonable. This as well. This as well. This is a bit of a fail because it's below 5%. All right, this as well. And you get what I mean, right? So which are the ones that are too expensive? So example, Keppel DC REIT is a great REIT, but it's too expensive. The price to NAV is 2 times. Are they nuts? And the dividend yield is only 3%. Are they nuts? Yeah, I won't pay that price. Only dumb people pay that price, right? This is also a pretty good REIT, right? This is like 0.9 and 8% yield. So again, I've been buying REITs consistently, especially the last 2 months when it was even cheaper. Now it's still cheap, but it was even cheaper a month ago. But it's still quite cheap right now. All right, now let's take a look at US listed REITs. Now for US REITs, you can see the price to book ratio is quite different, right? For Singapore REITs, the average is 1.1, but for the US, the historical average is 2.2. So for US REITs, 2.2 is considered fair price. Above 2.2 is expensive, below 2.2 is cheap. But the yield measurement remains the same, right? I only invest if I get a dividend yield of more than 5%. It's below 5%, I don't find it worth it. Now, question people ask would be, why is it for US REITs, people are paying a higher price? Why is the price to book ratio double that of the Singapore REITs? Well, the reason is because of accounting rules. Yeah. You see, what happens is that price to book ratio is the price of the share divided by the book value, right? Now, book value is assets minus intangible assets minus liabilities, correct? Now, here's the tricky part. How the Singapore accounting system works and how the US accounting system works is really different, right? So Singapore follows the UK system. And in that system, the assets are marked to market. So what it means is every year, they will revalue the price of the properties according to the latest market price. So over the years, as time goes by, the properties get more and more valuable. So the asset gets bigger and bigger. So when the asset gets bigger, what happens? The book value gets bigger, and hence the price to book ratio is smaller. But in the US, the accounting rules are different. They use the GAAP accounting method, GAAP. And under the US accounting system, the assets or the properties held by the REIT, they are not revalued at the current market price. They take the book value of the REIT, which at the time when it was bought. So for example, if the REIT bought the property 10 years ago, the cost of the property is reflected in the asset and they deduct depreciation. So by doing that, the book value of US REITs are much smaller than Singapore REITs. So when the book value shrinks, the price to book ratio rises. So long story short, is because of accounting rules. That's why the way they calculate the price to book ratio is very different. Hence, you have a difference in the benchmarking. All right. Now, if you want to learn a lot more about REITs, if you're interested in investing in real estate, building a portfolio of the best properties in the world, do take up my REIT course, my real estate investment course that you can purchase on Piranha Profits. It's the entire course just on learning about how to invest in REITs successfully.